Hello, my name is Doug Lennox, and welcome to Smart Money Moves. We know that, and you know that. Those of you that are back, welcome back. I'm here with Adam Recker. Adam Recker is the real smart guy on the call, and that's why I get to introduce him, and he gets to talk a lot about what's going on in today's session. We're going to be talking about alternative investments, where they fit in, why they fit in, stuff like that. So Adam, as those of you who have gotten a chance to talk to him in person, is quite brilliant, and he actually understands both sides of the coin, which is there is a technical fundamental side of investing. There is a science to it all, but then there's also an emotional side, and he gets it. And so with that, I'm just going to start off, Adam, by asking you basically, where do alternative investments fit in and why do them at all? Why consider them or what's the where and the why kind of how about that?
Yeah,
Two-part.
the where and the why. It's always a good question. And so maybe to kick it off, let's just pull up the first slide here as a bit of a primer, and then we'll go to the second in a second. But I think as we know, Doug, and we talked about this a little bit beforehand, there's a lot of reasons why there could be value to investing in alternatives, whether it's and then in the where I'll get to, but the why really is probably the most important first. It could be due to a personal preference, a belief system, interest, as we discussed, things
Yeah.
that resonate with you that bring value to life. Or from a more technical perspective, it could be a number of things. Some key reasons are really to increase diversification is a great reason. Get access to asset classes that you just simply don't find in public markets. But of course, there's maybe trade-offs there, which we can talk about, or really trying to sacrifice maybe a bit of liquidity because these are assets that don't trade day in and day out. But the goal is to increase potential returns in the portfolio, or through another lens, maybe reduce the volatility or the perceived volatility of a portfolio, whether it's due to the nature of the investment or just infrequent pricing for the assets.
Hmm.
All of those factors together um, are really in pursuit of creating a portfolio that is easier to stick with from a behavioral standpoint, ride out the volatility, the ups and downs in the market, but also drive better outcomes over the long term for a client. So a lot of good reasons why you could do something, but then the what and what ways do we pursue asset classes can also be a very personal discussion or decision for any particular investor.
Well, and I think you're saying some things that really resonate with certainly me, and I'm hopeful everybody else as well. And you said let's start with why Simon Sinek figured out that was a good thing to do, and he wrote a bestseller. It is, why do we do it? And I use myself as an example. I've been involved in alternative investments. Initially, I did it for investment reasons, and then I did it for other reasons as my own net worth grew. And I had opportunities to do things for other reasons. So I looked at, I'll give you an example. I ended up owning a dairy farm, which I enjoyed doing for several years in Western North Dakota. But I got into it because my uncle and aunt were in it and they needed some support, and I ended up supporting them. And I ended up with the farm at the end of it all. And then I got into something that I'm still into now, which is I'm involved in the largest dinner theater in the country in Chanhassen, Minnesota. And the reason I did that one is it was really about it was a lot of personal reasons and a lot of reasons that were more values based. Like I really value the theater itself, but the theater was close to closing, and there would be 300 jobs that would go away. And I actually thought this could be run, and it's not a nonprofit. This is a for-profit or for loss, either one. And we decided to go ahead and do a for-profit. But the why included all those other reasons, and that's what you're saying. And
Mhm.
I want all of our audience to understand that we get it. that there are a lot of reasons why. And then there's a lot more what's than you thought. Some people own things that are alternative investments and they didn't even know it was an alternative. You probably got examples of that.
Absolutely. So maybe let's go to the next slide, to kind of address that, and the previous slide, just to kind of elaborate the illustration. With alternatives, like many investments, really, they should be viewed as long-term investments. These are not things that you can trade in and trade out on a short-term basis. Really designed to hold over the long term, full market cycles, let businesses develop, so you can ultimately, ideally, reap the long-term benefits of these asset classes. But speaking to the specific sort of asset classes within the broad alternatives umbrella, some may be assets that you may already be invested in and don't completely realize it, or maybe look at it the same way. But private equity, for example, what is that? What does it mean? Many are familiar with public equities like the S&P 500 index funds, world stock index funds, or Apple, Google naming specific companies that trade on a public market day in and day out. The reality of the economy, though, is more companies are private than not. Most of us work, in many cases, for private companies. That ultimately is what private equity is. It's being able to invest in those private companies that many of us work for, that just aren't accessible through the public markets. The benefit there is, again, sacrificing liquidity, but ideally getting access to a more diversified set of companies than just the largest companies in the US, where often you may find faster growing companies with long-term potential. And so for a growth-oriented investor, owning a slice of companies or exposure to this segment of the market could potentially bring value, both from a portfolio perspective or just from, even again, a values-based perspective. Another good example, real estate. That's one that probably many are most in tune with, probably resonates the easiest, because many of us own property, whether it's the home we live in or placing excess savings into rental properties and things like that. Real estate through a private lens is exactly that. It's not a publicly traded real estate vehicle. It's really hiring a manager to go out and find those attractive opportunities throughout the country or potentially the world to generate steady income, potential for appreciation, inflation protection, attractive attributes like those. But then, even speaking to the example you had, Doug, where like a dairy farm, for example, farmland, other real assets, we have access to, farmland investments potentially, or other infrastructure investments like data centers with the growing AI theme, or being able to invest in companies that build bridges, clean energy, things that may resonate but are essential for the growth of the economy, making sure the economy can work as designed while providing steady income and potential inflation protection characteristics.
Mm-hmm.
And then private credit, a growing asset class in its own right, where traditionally banks would lend to companies, but there are certain restrictions where they can't lend like they used to for one reason or another. And so instead of investing in public bonds that often investment grade, but maybe not as high yielding, can still invest in well-run companies, but due to structural issues, maybe be able to garner higher interest than what you would find in an investment grade bond. And so for any given investor, it could be one of those asset classes. It could be a mix of asset classes, where
Yeah.
our view, though, is, everything in moderation. It may not be appropriate for everybody. Not every investor has to have alternatives, but for some it may make sense. And then
Yes.
it's on our team to tailor it to their
Yes.
needs.
I like that a lot. And we've spoken in the past too about what I've referenced and called the smart money philosophy. And all of this is really about that. Diversification is a lot about that. And it's just being in a situation where we tell you the truth. The truth is we don't know what's going to happen for sure. That's why what we do for a living is we prepare people for the truth.
Yep.
The truth is uncertainty. because we don't know what's going to happen, what we want to do is position all of our clients such that whenever they need money, there's a smart place to get it. And so
Yep.
we're never trying to put all of our money in the smartest place. So we don't do that. And so within what Adam just said, there's a framework for that.
Yep.
So, and as he said, this is in the long-term category because it's not one, if I need money tomorrow, you call up Adam and say, hey, Adam or Doug, we need some money. You don't take it from here. It would come from one of the other places. And that's what our advisors and our investment people who support them all understand all of this. So the clients get to decide what is it that you want, and then we get to help you and collaborate with you on what role do you play and what role do we play in making it happen. So I liked how you said this. And by the way, we're sitting in a company that's a privately owned. I mean, we're a private company, and this is not a publicly traded company, and we feel quite good about it. And we're growing quite fast thanks to people like Adam and the other people who support you, that those of you who are clients, and thanks to all of you who are our clients. Thanks. Those of you who aren't yet, please consider it. Thank you. Back to you, Adam. We should probably go
Yeah.
to another slide.
Yep.
Keep
So I think
getting away.
speaking to the framework a bit, again, a little bit of the data behind it. And so fortunately, we have a lot of good resources. This one here, and it's actually the following one as well, generated by JP Morgan. They have a great deck that goes out on a quarterly basis to really help get a sense of what's going on in the alternatives market. And one of the key things that really resonated was, talking about the diversification or the correlation benefits. And correlation really means that you want to find investments that when one zigs and goes one way, potentially another one goes another way. Because we
Which,
know
by the
part
way, just real quickly says, so if one is zigging and one is zagging, and I needed to liquidate something, you can decide which is the one I would want to move at that time. So it's all part of the thing. So sorry about that little color
of,
analyst version here of this.
and so the data, though, the things that are helping us make these decisions, say things like, well, let's look at a 60-40 stock and bond portfolio. What are things that can potentially act differently in a good way than that portfolio? And so certain things on the right-hand side of the screen, the further right they are, the more similar they are from a risk perspective or return perspective to that portfolio. And so things like private equity, more like stocks, or venture capital, like really high growth potential stocks, but riskier, they may have a higher correlation to a 60-40 portfolio that has stocks in it. But as you move to the left, you see things like maybe real estate or transportation and infrastructure, which are in a lot of ways different than stocks and bonds, your standard stocks and bonds. And the idea is by combining all of those ultimately, you can get a portfolio that has higher given returns for any given level of risk. And as those larger bubbles show, potentially even greater income attributes than what you would find in those more traditional asset classes. Kind of
Yeah, I
right there.
like that. I like, and if someone's just looking at this, what do you think they should draw their attention to? The eyes, what's it telling them? Are the big bubbles good? Are the anything like that?
Big bubbles are higher yield. And so, kind of for reference, I would say that the way I would interpret it, like things like direct lending, so bonds in the private credit space,
Right.
or infrastructure, those bubbles generally are maybe a little bit bigger than what you'd see in the 60-40. There's just simply more potential for income from those just structurally in those investments. And so, part of it's knowing what you potentially could own versus if you're going to buy something like private equity. It's more equity and growth oriented. You don't buy it for income reasons in many cases. It's a capital appreciation reason.
Yep.
Or
Right.
even certain like hedge funds, not as maybe as popular these days as what they were once in the past, more like a 60-40 portfolio, not really an income generator. And so the thing here is it really helps you understand, do I want to own things that are more like my portfolio, or do I want to buy things that could be true diversifiers?
Right. I like that.
So
And the whole concept of smart money, remember, all of us want to be in a position that no matter what happens, if our family or we ourselves individually need to put our hands on some money, there's a smart place to get it. And what we're wanting to make sure our clients understand so that they can sleep easy is that's what we do, is we position you in such a way that when you need money, there's going to be a smart place to get it. So I really like this slide, and I bet the next one's pretty good too.
yeah, the next one kind of brings it, I think, a little more full circle. And so the idea here, very briefly, is looking on the left, there's a 40% equity, 60% bond portfolio, kind of a traditional portfolio. And you can get a sense of what the expected or annualized returns have been for that portfolio and the volatility associated with it. And that applies to also the 60/40, 80/20 stock and bond, any risk level you really are seeking to achieve. Again, nothing in life guaranteed, but the idea is through these diversification benefits, we either want to be able to maintain a consistent level of risk and get higher returns over time, or you can maintain sort of the return and have a lower level of volatility. And
Now,
so,
are you finding, Adam, just, and it's kind of interesting. I think about it, I was thinking about it for myself just for a moment, because conventional wisdom has been over the years that as one ages, they should become more and more conservative. And then recently, various people that like Michael Kitces, are saying, wait a
mhm,
minute, we're actually going to live longer than you thought, and we're going to have to stay in equities a little longer than you thought. What
yep.
do you think about that? And then how does that relate in general to this kind of thing?
Yeah, I think it's not a straightforward answer, but and I think this is something we can touch on maybe in a following slide here. I think you have some maybe prepared thoughts on it, but it's really about aligning the investment with what your goal is in the time horizon, which may be your lifetime. It could be a different, it could be a beneficiary's lifetime potentially. And
Yeah.
so maybe a key fit could be for those that are younger and maybe don't need the liquidity, they're saving for longer. Investing in illiquid assets isn't a big risk because they're not going to be spending the money anyways anytime soon, possibly for decades. Or even as you're progressing through retirement, maybe even in the later stages of retirement, depending on where an investment is held, it could be held for your benefit in a way, or maybe it's something where you're trying to grow money to leave a greater legacy for someone that's set to inherit that money. And
Well,
so,
and I actually use that term for myself, legacy assets, and what I mean by that is assets that intend for my family to continue to own. So they will be assets that go on and hopefully for generations. And
yep,
so there's things such as that, and I like that descriptor. That's very helpful because again, and you mentioned the goals matter because you might be planning on something that somebody's going to get after you are no longer here. So the
yep,
liquidity during your lifetime matters very little. In fact, doesn't matter at all. And
right,
so that becomes an important point. And those goals, by the way, those goals we think about as it relates to what you care most about. So when you say things like, I really care a lot about my grandchildren, and I worry and concern myself with them, I want to plan for them, you're making a values-based statement. So we talk about values. What do you care most about? Well, I care most about my family, or I care most about whatever you care most about. We don't pick that. You do. What do you value the most? Our job is to make sure that you consider what you value most when you're making a decision so that you don't make the wrong one, which is what oftentimes happens. So I like how Adam said it, which is goals help you decide what to do, and values help you decide that as well. So if you think about it this way, think values, what do you care most about? Goals, what are you trying to do? What are you trying to accomplish? Behaviors. What do you have to do? And what do we, in helping you, have to do? What do we have to do to make it happen? That's a behavioral doing thing.
Yep.
And then what we call collaborative advice. We collaborate with you and we agree on what does Adam Recker do? What do you do? What does Doug Lennick do? What do you do? It's like that. Oh, back to you, Adam.
Yeah, so maybe moving on to the next slide, I think one of the things we have prepared, Doug, is obviously there are risks and there are reasons why things should be avoided. Some of them are definitely valid. Others are just other psychological barriers we need to overcome if we're going to succeed in an investment like this. And so I don't know if you wanted to touch on some of those as well.
Yeah, I'd be happy to do that. I mean, we talk about biases, and of course, one would like to think I am not biased. And originally, even Markowitz, when he wrote Modern Portfolio Theory, was well, the theory was people could be not biased, but as his life progressed, even he came around and said, truth is, people are biased. We just are, and knowing that is a really good idea because then we can mitigate against them. And these biases help us make some pretty poor decisions sometimes. Familiarity bias, we're comfortable with stuff we know, and that might get to a point of overbalancing into those kinds of things. Liquidity bias, a lot of people are so afraid they can't get their hands on the money. You don't need to get your hands on all the money. Using myself as an example, a good chunk of my personal value is in illiquid assets. And one of my most important needs is liquidity. So I make sure I have liquidity because there never know when you might need a lot more. So the liquidity, but a lot of people have it as a bias, which means they have to have it on everything. And that tends to disadvantage you in the long term. That's the deal. It's good in case you need money today, but you don't need all your money today.
Yep.
Aversion, loss aversion, complexity aversion, people get scared of losing money. Obviously, the fear of losing money is strong. But what I have discovered over time is it's even worse. It's the because we assess risk because people actually want to say, I'm willing to take a risk. And I don't know, Adam, how often you hear this, but when they come to a financial professional over my career, most of the time, when people came to me and said, Doug, I'm ready to take a risk, I was translating that into what you mean is you're prepared to accept a above average return. I've thought it through. Is that what you've experienced, Adam? That's
That's
what
the
they
goal.
mean,
The goal is I'm prepared and I will accept an above average return. But
right?
of
Because
course,
it's a loss issue. People
yeah.
don't like losses. Losses, I wasn't talking losses, I was talking a risk. The reason I hired you is take the risk out. No, what we do is we mitigate against risk and we deal with these psychological issues as well as the real issues of the investments. So your comment on that, Adam.
Yeah, no, I think those are all good. It's obviously, we can't mitigate every risk, and there are real risks here. Like illiquidity is a risk, and it would be remiss not to address it because there are, and it's not intentionally calling anybody out in particular, but you see in the media talks around like the Ivy League institutions being over allocated alts. There is a lack of liquidity there, which is causing pain for them. That is a risk. And that's why there have to be appropriate guardrails. One, identifying is this appropriate for a client? And if so, how do we make sure to not sacrifice too much liquidity? Also, making sure the managers are decent managers. That's an important aspect, which we can show here in a second. Or even making sure are the higher expenses associated with many of these investments worth it? Investments that don't go to us, but they have to be reasonable relative to the expected reward. And so maybe going to the next slide too, just to be able to share it. The idea is, again, you can see public equity, private equity. if we can make peace with these potential trade-offs, and it is right for a client, the idea is that you can see here there's been strong returns for really global equities, public equities, and then also private equity. This isn't an either or decision. The idea is really the mix of the two may create a more stable portfolio where if there's a period where public equity falters, maybe the private picks up the slack. And then in environments where maybe privates are lagging, it's because public markets are doing very strong. But it's about diversification in the end.
Well, and even in some of these private investments, at some point there becomes a liquidity event, and you get to decide, do you want to stay in that investment or do you want to take advantage of the liquidity event? Talk about that. How do most people in private companies get liquid?
Yeah. So, and maybe let's check the next slide too, because this may be a bit topical. Or maybe maybe the next one too, while we're at it, just for the sake of time. But talking about the actual allocations, and so the liquidity aspect, I would say it's either it could be that a company that is private goes public. That's been a traditional way. That hasn't happened so often. It could be that you're invested in a fund and the company there becomes attractive to a different fund or a different investor. They may buy it. That creates an opportunity to give liquidity back to investors. Some of these investments have natural cash flow associated with them. So again, like the real estate, the infrastructure, they are designed to pay out liquidity over time to compensate investors as well. But again, the risk is, will there be enough liquidity? Because some environments have more than others for one reason or another. And that's where you can see, depending on your time horizon, you want that to match up well. And so looking at an institutional investor in the kind of top pie chart here, the average, it seems to be, most of it is in public markets, but a sizable portion, 22%, for these institutions that effectively should have infinite lifespans in a sense, are willing to lock up more liquidity. Again, Ivy League, much higher than that still. It's actually kind of almost flipped, 60% into liquid assets. That may be a bit overdone, as we can see, at least in this environment. But the average investor is nowhere near that in many cases. Even the most very high net worth family office like clients, net worth of 30 million plus, they're looking at maybe 20% in alts. And then for more of the high net worth investor, 5 million to 30 million on average, really they're just starting to dip their toe in the water, so to speak, only 2%.
Yeah,
And
yeah.
so our take on that is really there have to be appropriate guardrails again. For someone that doesn't need liquidity, if we get up to long term, something like 20, 25%, we think that can be reasonable. It still leaves plenty of money for liquidity and needs that a client may have. For someone
Well,
just starting, maybe less.
well, and one thing too, and I know we're coming to the end here, that I just want to kind of point out, this is also a fun fact, so you'll have fun with your friends when you mention this. But two-thirds of the people in the world, in the history of the world, that have ever been 65 years of age or older, ever, add up all the people in all of history of humankind, two-thirds of 65-year-olds and above that have ever been alive are alive today. That's true. And so we are living longer. Social Security was meant for you to die at 65. It didn't work out. So I didn't die on time. I'm still alive. I'm north of 65. And so we have to start thinking our life might be longer than we thought. And so long terms are some things we want to take into consideration based on what we care most about, who we care most about, and what our goals are. I know we've got another slide or two, but I don't know if we have time, and Mia will tell me and hook me away. So
Yeah.
key takeaways, we got time for that.
Yeah, I think that, and this flashed over so briefly. I mean, the takeaways really are we believe that for the right investor, and this isn't something that is mandated that you must do. It really is a personal decision that we, the team, the investment team, we have professionals that focus on alts. Our head of alternatives helps with this, where we're looking through the different opportunities out there on behalf of clients, available to have those discussions with clients and the advisors, figure out, is it the right thing for you? Because it's not the right thing for everybody. It really is a personal decision. The values come into play. Part of it is also explaining the pros and the cons, helping overcome psychological barriers, whether they're valid or maybe it is something that's just a matter of education and getting comfortable. But overall, like much in the world is very black and white and not a whole lot of nuance. In our view, this is something where we want to be more thoughtful about. It's not an either or, all or nothing proposition. We think there is a place for it in many portfolios. And at the same time, there are some people that they don't necessarily need it either for success. And so we're really here to help you make those decisions.
Yeah, yeah, you make a great point. And so we got to wrap it there, but we love having you here. So please come back next time, bring your friends and bring questions. I forgot to, that's my fault. You're welcome to ask us questions and we're supposed to answer them. So bring those next time. Thank you very much.